Hello everyone, this is Dr. Hessa Al-Fadhel, the course coordinator of Accounting 112. In this video, I'm going to explain Chapter 1, Part 1. The first learning objective of this chapter is to explain the purpose and the importance of the accounting. Okay, so let's start with the importance of accounting, or the definition of accounting. So what is accounting? Accounting is an information and measurement system that identifies, records, and communicates an organization business activity. So let us try to simplify this definition. To simplify this definition, you have to remember, accounting is about identifying, recording, and communicating. So what do I mean by identifying? Identifying, it means that you have to identify the transaction or the event occurs in the company. Let me give you more example. If I am Apple Store and I sell an iPhone, if I ask you, what is the transaction that the company just did? You should answer and say, sales transaction. Why it's a sales transaction? Because the company sells an iPhone. Okay, let me give you another example. If a company purchase, for example, equipment. So what is the transaction here? It's a purchase transaction. Why it's a purchase transaction? Because the company just purchases an equipment. So identifying means I have to make sure that I can identify which transaction that the company is doing. Is it sales or purchase? Then recording, what does that recording means? Of course, if I'm a company and I sell, for example, an iPhone to a customer, what I'm going to receive? I'm going to receive cash. Why? Because me as a company, I just sell the iPhone and I receive the cash from the customer, and me as a company, I'm going to give to the customers a receipt. So now my cash is increasing. So I have to record that we received cash from selling an iPhone. Or if we purchase an equipment, here my cash is not increasing. My cash is decreasing. Why? Because I am as a company, I just purchase. In order to purchase, I need to pay money. So I need to record that my cash is decreasing. So this is what we mean by recording. You should record what happened. You have to input what happened exactly. Did the cash increases or the cash decreases? Communicating means that I have to prepare and analyze and interpret. What does that mean? Every end of a month or end of a year, the company required to prepare reports such as the financial statement, so they can see how much is the sales, how much is the purchases, and did the company do any profit or losses. So the communicating part is very important. Okay, the learning objective 2 is to identify users and the uses of an opportunity in accounting. So who uses this financial information? We know that accounting is a language of business, and all organization needs to prepare and communicate their financial information. In accounting, we have two users, external users and internal users. Let us now focus on the external users. What do I mean by external users? I mean users that they are interested in the accounting information, but they are outside of the company. They are not inside the company. That's why I'm calling them that external users. One of the examples of the external users are lenders, or what we can say banks. Let me give you here an example. Why banks or lenders are interested in the financial information of a company? Let's say, for example, I'm a company, X company. My company name is X. Company X needs money. If they need money, definitely they are going to go to the bank. So X company goes to the bank and tell them, I would like to take a loan of 10,000. The bank will not accept directly. They need to go and check the financial information of this company. Why? Why do you think it's important? Well, it is important because the bank needs to make sure that company X are doing good in the market and they can pay back the loan. That's why the financial information is considered very important for the external users as a bank. Okay, let's see the other type of external user, shareholders, or what we mean as investor. If I'm an investor, I would like to invest my money in a company. But of course, I want to invest my money in a good company or profitable company. Why is that? Of course, I don't want to spend my money in a company that they're doing losses. Therefore, the best way to ensure that I'm investing my money in the right company, I need first to check their financial information. If I check the financial information of company A, for example, and I saw that company A are doing losses, then in this case, as an investor, I'm not going to risk my money in a company that's doing losses. But if I go to company Y and I check their financial information and I saw that this company is doing profit, then of course, as an investor, I'm going to invest my money in company Y. Therefore, the financial information is very important for the investors. Regulators. Who are the regulators? The regulators are the governmental body that regulates the market. For example, in Bahrain, Central Bank is the regulators of the companies and banks. So, the government or the regulators, they need to make sure that all companies and banks are following the rules and preparing the financial information accordingly. So, therefore, the financial information is very important for those regulators to make sure that those companies are performing well in the market. Now, let's see the internal users. The internal users are users that they are inside the company. For example, managers. All managers, any type of managers, research and development managers, purchasing managers, marketing managers, production managers, distribution managers, all managers inside the company also they are interested in the financial information. Why is that? Because it will help them to identify, evaluate the company overall. Let me give you here an example. If I am a marketing manager, or let's say production manager, and the company is selling 3 different products, and then we found that we have product A, product B, and product C. Then we saw that product C, the sales of product C is not that good. Me as a production manager, I need to go and see why the product C, the sales of product C is too low. So the financial information will show me why it's too low. So therefore, as a production manager, I'm going to go and check and I'm going to decide whether to still sell product C or discontinue it from the market. So those kind of information will help the manager to take decision to evaluate the company's performance overall. Now, let's move on to the learning objective 4. Explain generally accepted accounting principles and define and apply several accounting principles. In this semester, we're going to prepare or we are going to learn how to prepare the financial statements using the generally accepted accounting principle, GAAP. What is GAAP? Let me give you here a scenario to make things easier for you. Let's say that we have 10 companies in the market, and each company requires to prepare their financial information. And if each company use their different way to prepare the financial information, we will end up with 10 different financial information way to calculate either profit and losses. And this will create a confusion for the investor. If I'm an investor and I would like to invest my money in a company, I have company A and company B. If company A is using different way to calculate or to prepare the financial information, and company B have a different way to calculate and prepare their financial information, me as an investor, I'm not be able to compare two companies together because each company is using different way to calculate their financial information. Basically, can I compare orange with apples? Not at all. I need to make sure that in order for me to compare both companies, they need to use same accounting principle. So then I can compare apple with apple. Therefore, let's say for example, all of the companies here, they're using one accounting principle and standard. Why? Because to make the life easier for the investors, all of the companies should follow the same accounting principle. Because if I have same accounting principle, general applied with all companies, that will make the information more relevant to take a decision. And it will make the information more reliable and trusted. And it will make the information more comparable and helpful in contrasting organizations. So therefore, there should be one accounting principle. And in this book, we're going to follow the generally accepted accounting principle that is used in the US. And also we have an international standard. The US GAAP, it is the US accounting standard. But the international standard, if the company is trading in an international market, then they need to use an international standard. You cannot use the GAAP because the GAAP is only adapted for the US market. But if the company is trading in international level, then you need to have an international standard. Okay. Now I'm going to explain a very important part of this chapter. Please pay attention. In accounting, we have 4 accounting principles and 4 accounting assumptions. Now, I'm going to focus on the accounting principle. What do I mean by accounting principle? Principle means that the company needs to follow those principles. The first principle is the measurement principle, or what we call it cost principle. What is a cost principle? Cost principle says that accounting information is based on actual cost. Actual cost is considered as the objective. Let me give you here an example, which will make this principle easier. If I have a company X and company X purchases a PC and it costs them 350 BD, it means company X went and purchased a PC and they pay how much? 350 BD. But the PC worth in the market 400. Which cost company X will record in their account? Do you think they are going to record the 400 because the PC worth in the market 400? No. According to the accounting principle, the accounting information should be recorded based on the actual cost. What does actual cost mean? It means how much the company actually paid in cash. They have to record it. I don't care how much this PC worth in the market. Even if it's worth 1000 BD in the market, no one cares. How much did I pay? How much is the actual cost that I pay in order to purchase it? Should be recorded. So in this case, I'm going to record 350 BD is the actual cost. So the cost principle means that all of the accounting or all of the company, they have to follow the cost principle. They have to record what is the actual cost. We don't care how much it's worth on the market. It's worth 1,500, but if I pay 350, then it should be recorded in my account 350. How much is the actual cash paid? So this is the cost principle. The second accounting principle is the revenue recognition principle. Let me just jump directly into the example. Okay, if I am a company, a service company, okay, I'm a service company. Let's say I'm a company that provide a legal services or a legal consultation. And you came to me and asked me to provide you a service. You gave me a cash, but I did not, and I took the cash from you, but I did not perform the service yet. So can I record the cash as a revenue? Not at all. Why? Because the revenue recognition principle says that in order to record the cash as a revenue, you should first complete the service. If the service is completed, then the cash is going to be recorded as a revenue. Okay? Again, if I receive cash before providing fully or complete fully the service, the cash is not going to be recorded as a revenue. Only if I finish the service and I complete it, then I'm going to record the cash as a revenue. So what does that mean? So we have here a condition. If cash is received before service is completed, cash is not recognized as a revenue. But if the service is completed, then the cash is received is recognized as revenue. This is what we call the revenue recognition principle. Now let's move on with the third accounting principle. The third accounting principle, it's expense recognition principle, or what we call it matching principle. When I say matching principle, it means that the company is going to compare their revenues, the cash outflow, and their revenues, the cash that they receive, the cash inflows. Why they are going to match it? Because they want to know at the end of the year, did the company did any profit or losses? Let me see here example 1. Example 1, they say that we have a revenue of 10,000 BD and we have expenses of 5,000 BD. So if you match them, what do you mean match them? Compare them. So my revenue here is higher than my expenses. Then it means that I have a profit. Why? Because 10,000, my revenue, minus my expense, which is 5,000, will give me 5,000. So I have 5,000 profit. Let's see the other example. Example 2. The revenue is 5,000 and the expenses is 10,000. So here my expenses, my cash that I'm spending out is greater than the cash that I'm receiving in. Then of course I'm going to have a losses. So 5,000 minus 10,000 will give me minus 5,000. So again, the matching principle means that I'm comparing expenses with revenues. Let's move with the fourth principle, which is full disclosure principle. What do I mean by full disclosure principles? It means that the company needs to report the details of the financial statements. Everything related to the company, it should be reported. As I said earlier, that the company is required by each end of a year to prepare a report which includes all of the financial information about the company. So we need to make sure that all of the information is already reported. This is what we call full disclosure principle. Okay, now we're going to talk about the accounting assumption. And note please that there is a difference between the accounting principle and accounting assumptions. The accounting assumptions also we have 4 assumptions. The first assumption is going concern assumption. What does a going concern mean? Going concern means that we assume that all companies in the market will continue to operate instead of being closed or sold. All of the companies in the market, I assume that they are going to continue for 5, 6, 7 years. They are going to continue to operate in the market. They're not closed, they're not sold. The second assumption is monetary unit assumption. What do I mean by monetary unit assumption? Monetary first means money. And monetary unit assumption, it means that when the company is going to prepare their financial information or their financial statements, they need to make sure that they show which currency that they are using. For example, if I am X company and I'm in Bahrain, I'm going to record all of the numbers in my financial statement in a Bahraini dinars. Why do you think this is important? Because 10,000 BD is different than $10,000. So you need to make sure that you record the currency when you are preparing your financial statements. Because me as an investor, if I'm an investor from America and I would like to invest my money in Bahrain and I'm interested in company X, when I open their financial statement, I need to make sure that if the company, for example, they are doing a profit of 10,000 BD, then 10,000 BD is not like $10,000. Therefore, it's very important for each company to report their currency uses in their company. Okay. The third assumption is business entity assumption. What do you mean by business entity assumption? Let me give you here an example. If I am an owner of a company, if I am owner of company A and I have another company, company B. So I am owner of two businesses, company A and company B. Okay, when I'm preparing the accounts for company A, the accounts of company A should be separated from the account of company B. When I prepare the financial statements of company A, I should not mix them with company B. Why? Because I'm considering each company has its own entity. I don't mix the two companies together. Even me as an owner, I don't put my financial statements with the company financial statements. I need to separate my account from the company account. So I have to treat the company as a separate entity, as a separate individual. Okay, let's move now to time period assumption. So what do you mean by time period assumption? Time period assumption that the company needs to divide their accounting period. So every 12 months, the companies needs to prepare their financial statement. So this is what we call it the accounting period. The accounting period consists of 12 months and it depends on the company. If they want to for example, to start their accounting year from 1st of January, which means that they are going to be ended in 31st of December. But if the company decided to start the year from 15th of March 2019, so they are going to close the year in 15 March 2020. It doesn't matter when, but it should be 12 complete months to call them as accounting period. Now, this is very important. Let us see the characteristics of each business entity forms. So as we said, if you are a sole proprietorship, which means that number of owners will be only one. You are the only one owner of this business. Business taxation. So the sole proprietorship companies that has only one owner, they don't usually pay business tax. Why? Because they're small companies. They don't need to pay tax to the country. Owner liability. What do I mean by liability? Liability means the debts or the obligation that the company needs to pay back. In the sole proprietorship, we have unlimited liability. What does unlimited liability mean? Let me give you here an example. If I am an owner of a company called H Company, and H Company has a debt, needs to pay money to other company, but I am as an owner, I don't have money to pay. So in this case, Who will take the responsibility of the payment? Of course, you are the owner, you are the only owner. So, of course, if there is any debts, any liability, any obligation, you have to take the responsibility of everything, no one else. Okay, legal entity. No separate legal entity. Business life, those kind of small, I would say, companies. Usually, if you are the owner of one company, usually those small companies, the life cycle in the market is short. They don't last in the market for a long time. Okay, let's move on now with a partnership. Number of owners, of course, we are talking here about partners. It will be two or more, and we don't call them as an owners, we call them as a partners. And of course, this is very important, and you need to remember that the partners, when they decided to start up a business, they should agree. There will be an agreement between them. Agreement how they are going to divide the profit of the company. If there is any losses, who will take the responsibility of losses. So when you are trying to form a partnership company, you need to have an agreements between the partners. And those partners company usually are a small company, and they don't really need to pay any of the business taxation to the government. Now, when it comes to the liability, here there is a cases. If the partners, for example, decided or agree from the beginning that if the company is having losses or if the company having debts, they either share this kind of liability equally. Let me give you an example. If I have partner X, Y, and Z, and the company has a liability, who will take the responsibility? X, Y, and Z will take the responsibility if they agreed from the beginning that they are going to take the responsibility of splitting the liability. Or the company or the partners, okay, this is another case, or the partners can, for example, agree from the beginning that if X, he's the one who brought up this kind of liability, he's responsible, then Y and Z, they have no responsibility. So we have two cases here. Business life, again, this kind of partnership are small companies, I would say, small partnership companies. So they don't last really long in the market. Now, corporation. Corporation, it should be one or more. And we don't call them as a business owner, we call them a stock or shareholders. For example, if Muhammad is interested to be part of Apple company, to own part of Apple company, he can do that. How? He can go and buy shares from Apple company, then he can call himself as a shareholder of the Apple company. Do you think that the business taxation is applicable to corporation? Yes. Corporation usually are big companies like Dell, Apple, Microsoft. Those are big companies. So those big companies, they are required to pay a business tax to the government. Okay. Owner's liabilities. When it comes to the liability, Muhammad now he purchases a share from Apple company. So he can call himself a shareholder. But he has a very limited liability in this company. So if the company is suffering from debts or like liabilities or obligation, Muhammad has nothing to do. He don't pay, he has a limited liability. Usually the business life or the business cycle of this corporation is longer, indefinite. Big companies like Coca-Cola, like Apple, they last in the market for long because they are big companies. Okay, we also have limited liability company. Limited liability company is also, we can consider it as a part of the partnership, and I already spoke about it. So usually it is one or more, and we call them members. They don't pay any income tax, and they do have a limited liability. And also they have indefinite life, which means that they can last in the market for very long of time. This is the end of Chapter 1, Part 1. Please check Chapter 1, Part 2.